Hello and welcome to yet another episode. Today being on a Friday, the 23rd of January 2025, 2026, sorry, and the year is the month is actually about ending. And in this video today, I want to talk about what a good trade actually looks like, even when it's losses. Okay, so what a good trade actually looks like, even when it's a losses. So that statement alone, or that topic alone, tells you that a good trade can lose money and still be a good trade. Most traders never understand these, and that misunderstanding keeps them stuck for years. Okay, so beginners judge trades by outcome, but professionals judge trades by execution. So execution is everything. I've always repeated this, and it's a theme that is coming out on all the series of videos that I've been able to do. Execution. That is what professionals basically judge their trades by. So if you only feel successful when you win, you'll break rules the moment you lose. And in this video, I'll show you what a good trade actually looks like, even when it ends in reds. All right. So this video is for traders who get emotional or emotionally attached to wins, feel discouraged after losses, second guess themselves constantly, or keep changing strategies after one bad trade. So, because if losses shake your confidence, then this video is going to reset how you see trading. Here is the mindset shift that changes everything. A good trade is defined before entry, not after exit. Okay, a good trade is defined before entry and not after exit. Once you understand that, losses stop feeling personal and improvement becomes very possible. You start improving yourself. So let's look at, to be able to understand this, I want us to look at the first part I want us to look at is outcome versus process. So most traders think in this manner, that win is a good trade and loss is a bad trade. But shock on you if I tell you that mindset is toxic. Why? Because markets are probabilistic. They work in probability. Even the best setups do lose. Even institutions lose trades. So if losing automatically means you did something wrong, then probability becomes your enemy instead of your framework. So professional traders, they think differently. And this is how I want you to start thinking differently. Did I follow my plan? Was the risk controlled? Was the setup valid? Did I execute at the right time? If yes, that is a good trade. If no, that is a bad trade, because outcome is irrelevant in the short term. Okay, so I'll repeat that again. Professional traders think differently and they ask themselves this kind of question: did I follow my plan? Was the risk controlled? Was the setup valid? Did I execute at the right time? So if yes, that is a good trade. If no, that is a bad trade, right? Then the other thing that you need to understand, or what I'm going to give you basically in this, the next part of this, is the four criteria of a good trade, right? The four criteria of a good trade, because we have to define what is this good trade. How does this good trade looks like? Okay, so and the first criteria is a clear reason for entry, right? You have to have a clear reason for entry. You didn't enter because of boredom. You didn't chase price. You didn't trade out of FOMO, right? Make sure that you didn't enter because of boredom. You didn't chase price. You didn't trade from FOMO. So there has to be a clear reason of entering. For instance, you entered because structure aligned, liquidity made sense, timing was correct, the setup fit your model. So if you can't explain why you entered, it wasn't a trade, it was a reaction. Okay, if you can't explain why you entered, that was not a trade, it was just a reaction, it was just pure gambling. Criteria number 2, define risk before entry. Why? Because a good trade should have a stop loss, a predefined risk in percentage, and an accepted loss, right? An accepted loss. For instance, you should have your stop loss, and this stop loss, probably you're risking 2% of your account where you put the stop loss. And that 2% is what is your accepted loss. Okay. So before clicking buy or sell, you already accept the outcome that if this trade goes into a loss, I am willing to take that particular loss. I have accepted that. So if you think I'll just see how it goes, that's not trading. That's basically hoping. And market doesn't reward hopes. Right? Criteria number 3, proper execution. I repeat that in caps. Proper execution. Execution basically means entering the trade where you had planned to enter the trade, not chasing the market, not hesitating, not over adjusting. Okay? Even a great setup can become a bad trade if execution is sloppy. So, like for instance, late entries, early exits, emotional adjustment, all this can ruin a good trade. Okay, so therefore, a good trade respects precision. A good trade should respect precision. Criteria number 4, emotionally neutral. You have to be emotionally neutral because emotionally neutral meaning that you can the trade can go into losses, the trade can go into profits, and you have to accept that. Whether it goes in losses, accept it. Whether it goes in profit, accept it. Don't cry so much because of losses. Don't overjoy yourself so much because of profits. Okay, so, and emotional neutrality is actually the hardest one to master because a good trade feels boring, calm, controlled. But there is that boringness to wait for that trade. You feel so much bored. Okay. But if your heart or if your heart rate really spikes the moment you enter, then you need to know that your risk is too high. And I've always said that if you keep checking your screen, you feel your heart rate beating very fast, you are not at peace with yourself because you have entered a trade, then you know that your risk is too high, or maybe probably your confidence is too low. Because one of the things that I can tell you in trading is that emotionless execution is a skill. And if it's a skill, it means it's something that you really need to build on, right? It's something you really to build, you really need to build on. Okay. So let me give you a quick one, like a quick example here. Let me share my chart so that you can be able to see this quick example that I want to give you here. This is a trade, right? This is a trade that I took around this particular point. Okay, I think we traded this trade on Wednesday. I had actually shared it even in Discord. I think during our live market analysis, I shared that trade, and everybody was able to take that particular trade. But there are some things I want us to learn from this particular trade. The first thing I want to look at it in terms of the 4 clarity points that I've been able to share. I've talked about the 4 criteria of a good trade. Clear reason for entry. So I took this trade. Number 1, the reason for entry here was the price has given me a BOS, right? So anytime I see a BOS, what I do is that now I start marking my order block. The order block here, the bullish order block here, is the last sell candle, right? It's the last sell candle before the price pushes up, okay? And that's where we have that last sell candle. That's where we have it here, okay? So let me even expand this so that you can see. Okay, so this is where we have the last candle, the last sell candle. So these are bullish order block, all right? So, and with this one, so I waited for my entry at that particular level, and the price came, and guys, I told you that take a buy, all right? I shared in Discord. and we all took a buy. Okay, so because we have a BOS, we have the order block here, and the price has retraced all the way here. Okay, the price has retraced all the way back to the order block. All right, and apart from that, the aspect of time, as you can see, the price came here at 2:15 a.m. New York time, and that is when we have the London kill zone. Okay, that is when we have the London kill zone. So there is a clear reason for entry. Structure is aligned. We are bullish, right? We are bullish. So the structure is aligned. Liquidity makes sense. We have already seen the BOS is here being taken out. So liquidity makes sense, all right? The timing was correct. The setup fit my model. And that's why I'm saying you have to have a clear reason for entry. Number two, I've given the criteria that the price, there has to be a defined risk before entry. So if you look at this trade, I had a predefined risk, right? So it was about, because of right now gold is very tight. The peak value for gold was very tight. So of course I had to minimize my risk. I was not risking 2% here. I was risking 1%. So, but you can see I have that defined risk. This is where my stop loss was. I also have factor the risk to reward ratio. So as you can see, this is a risk to reward ratio of 1 is to 4.5. So basically what it means is that I am risking 85 pips to make about 380 pips. So it's very much profitable. So the risk is very defined. I have my stop loss. I have the percentage, predefined the risk in percentage, 1% of my account. Okay, and I was willing to risk to risk that. So in case it was a losing trade, I was willing, very much willing to accept that. Okay, so then there was the proper execution, guys. When I called this trade, I told you buy now, right? And I always say, when I say buy now, I always emphasize on proper risk management, right? And then I always talk about emotional neutrality. You know myself, I always talk about emotional neutrality. So in case that trade was not a winning trade, etc., etc. Even if it's a winning trade, you don't see me jumping all over saying we bagged it or whatever. That kind of thing, I don't do that stuff because I have trained myself to be emotionally neutral, whether it's a winning trade, whether it's a losing trade. And like I said, this is the hardest skill that you can be able to learn as a trader. Okay, so then why losing trades are necessary? Why are losing trades really are necessary? Okay, because yeah, we lose. All right, we lose. All right, and why is it necessary? And here's the hard truth that I'll tell you: if you never lose, you're not trading probability, because I also lose. I also take trades and lose. Okay. So if you never lose, you're not trading probability. You are under risking or not trading enough data, because losses are not failures. They are basically feedback. Losses are feedback. Okay. So losses, they are able to help you test discipline. They help you to expose the impatience in you. They reveal emotional triggers. They sharpen execution, because every losing trade is a mirror. Right, so a mirror is basically where you look and see a reflection of yourself. You want to analyze that losing trade and get to understand the reason why you lost the trade. Was it your mistake? Okay, so that is really, really very important. So the question is not why did I lose? The question is, did I follow my rules? You get the twist now? The question, the first question should come to your mind. It's not the question about why did I lose. It's, did I follow my rules? So you check and confirm that you followed your rules. Then that was a good trade, irrespective the fact that you lost that trade. Okay, let me show you. Here we have a BOS. All right, when the price was pushing up, we have a BOS here, and then maybe probably this is an order block. Okay, this last buy candle there is an order block. So what are we anticipating from this particular trade? Of course, our stop loss needs to be here. So you're anticipating the price to come here, and probably we looked at some buying opportunities. So everything, if you look at this kind of trade, a BOS, an order block, but the price is coming here at what time, guys? 1:30 a.m. That is outside the kill zone. So if you execute this kind of a trade, of course you did not follow your rules. Or if I was to execute this kind of a trade here for a buy, because it meets the criteria of the BOS, the order block, the price coming back to the order block, but the timing, it's wrong. The timing is wrong. So did I follow my rules? If I was to execute this kind of a trade yet, will I have followed my rules? No. So the reason why I'm saying the question is not why did I lose? The question should be, did I follow my rules? Okay. So and I've given you this example of these probably these a good trade. Okay, so if I lose in this kind of a trade, then that will be purely my mistake. Okay, so let me show you another example of a trade here, which is it was a good trade per se. It was a good trade per se. Yeah, let me show you that. See this? It was a good trade. Here we have the BOS. Okay, so this is the order block, right? The stop loss being slightly below this. So what's the time the price is coming to this level? That is 8:30 a.m. New York time. So which kill zone is that? That is the New York kill zone. Okay, the New York kill zone. So everything aligns, all right? Everything aligns, but now the price did not really respect. So here you take maybe probably a loss here, right? You take a loss here because the price really dipped deep. Okay, so with that kind of a trade, yes, it was a good trade, but you lost in that trade, right? It was a good trade, but you lost in that trade. Did you follow your rules if you are to execute there? Yes, I did follow my rules. The BOS, the order block, the price coming to my order block during the kill zone, and I executed. So I followed my rules. I had a predefined risk, such kind of things. So it's a good trade, but yet it went as a losing trade. Why? Because the market, we trade in probabilities. Okay, we trade in probabilities. So a good trade, all right, a good trade always, okay, a good trade um will when you're executing a good trade, you will have identified a valid structure, a liquidity sweep. Okay, a liquidity sweep. Let me get back here. A valid structure, we are bullish. Liquidity sweep, right? We have seen the price creating the BOSs as it moves higher, right? There is the liquidity sweep. There is correct session. So this is the correct session. It's the correct kill zone, right? And then now there is a clean entry. You can see when the price comes to this level, it really moves abruptly because of the aspect of price and time theory. I risked 1% in this trade. Okay, I placed my stop loss. I followed my plan. Okay, so that is a good trade. Even this one here, this is a good trade. I risk 1%. There is the liquidity here that has been taken out. I risk 1%. The order block, everything, time, it's okay. But price moves against me, hits my stop loss. Emotionally, annoying, yes, it's annoying to hit stop loss emotionally, but again, controlled. Technically, if you look at it technically, it's a perfect trade. Why? Because of 100 trades, that the same execution produces an hedge. I've always told you, if you want to know your hedge in trading, don't judge your result from one or two trades. Just look at a series of 100 trades that you have executed. What is your hedge? That is going to give you the hedge, okay? Because that single loss doesn't really matter. The process is what really matters here in trading. Because why am I sharing this? You know, I used to think personally. By the way, let me tell you the truth. I used to think um, I used to really think that in trading, okay, I used to really think that that in trading, every loss meant I was wrong. So I had to change strategies constantly. So today I'm trading this strategy, tomorrow I hit a loss, so I see that this strategy is not working, and then now I shift to another strategy. And those are the kind of things that I ended up doing, things that really ended up taking my toll time, because I was trying to learn one strategy. Today I'm learning one, tomorrow I'm a different one, because anytime I take a loss, I felt like my strategy was not right. But this is what I didn't realize, that I wasn't failing at strategy, I was failing at consistency. So, and immediately I stopped tying my identity to outcomes. Then I started to see progress. Progress started to accelerate, right? So, and this is how, or this is how I want you now to look at it. One loss or a couple of losses, they don't define really, the outcome doesn't really define your identity. It's all about consistency. And with consistency, you're going to see progress being accelerated. You're going to start seeing results. Okay. So let's lock these in this way, that a good trade is not defined by profit, it's defined by process. So good trades, they follow rules, they respect risk, they accept losses, and they repeat consistently. All right. Bad trades, they chase, they over risk, they break rules, and they depend on luck. So judge yourself by execution and not outcome. By execution, meaning, did you follow your plan? Was it the right time to execute the trade? Were you aligned with the structure? All right. That is the execution. So it's not about the outcome, but it's all about the execution. That's how professionals are built in the world of forex trading. And the moment I realized these guys, my trading changed completely. Okay. So in the next video, I'll talk about journaling and why most traders do it wrong, because reflection without structure is just memory, not improvement. So see you in the next one.